Hello and welcome. Today's tutorial we're going to be covering commercial earthquake as well as DIC coverage. My name is Carly Rom. I'm the marketing representative for Griffin Underwriting Services. Today's agenda, we'll go over a quick overview about GUS, Griffin Underwriting Services. We'll go over a product overview, some quick vocabulary. I'll give some description about the product, coverage details, and then as with each tutorial, I always end with a contact list should you need assistance or have any questions at a later date. So Griffin Underwriting was founded in 1928. We still are family owned and occupied by the Griffin family. We were one of the first surplus lines brokers in our region to be granted binding authority by Lloyd's of London. We're very proud of that. We have just over 100 employees throughout 3 different offices in the Pacific Northwest. We can offer solutions for personal lines, commercial lines, transportation, brokerage, and surety. We've written over $95 million in premium to date, and we are licensed in all 50 states, including the District of Columbia, which allows us to work with agents nationwide. So when we're talking about commercial earthquake, we've got some placement options. We've got the contract quake or the DIC. We have an exclusive contract. It allows us to have in-house binding authority as well as policy issuance. We offer exceptional rates. So if you have a property that was built prior to 1970 and or in higher risk locations, we are very competitive with those rates. We also are able to write this particular coverage in our brokerage department. We have 7 open market alternatives for new buildings. We offer excellent rates for frame, sprinkler, and fire restrictive structures. And we do have the option to write primary or excess limits for this particular type of coverage. When we're talking about vocabulary, we've got the total insured value or TIV, primary versus excess, period of restoration, coinsurance, loss limit approach, fully earned fees, and minimum earned premium set at 25%. So when we're talking about primary versus excess, the primary coverage, this pays the first dollar for the damage to a covered building or buildings. The limits can be scheduled or blanketed for multiple locations. As far as deductibles go, each building limit is typically scheduled or total value is set if it's written on a blanket. Our Lloyd's program is written on a scheduled basis, and they typically have smaller deductibles. When we're talking about excess coverage, this pays the excess damage once the primary limits are exhausted. So these policies have no coinsurance and have no deductible. The average rate is about 7 to 9 cents per 100 in coverage. We offer no restrictions on primary, no primary with, let me rephrase that. We offer no restrictions on the primary coverage. Preferably, we want to see them written with an A- rated carrier or higher. A primary written outside of a carrier that we work with is totally acceptable. And we can write excess for primary limits that have a limit as low as $1 million. When we're talking about a period of restoration, this is related to the business income. It's the period of time that begins 72 hours after the time of the direct physical loss occurs, and it ends on the earlier of the date when the property at the described premises either should be repaired, rebuilt, or replaced with a reasonable speed and similar quality, or is, or the date when the business resumes at a new permanent location. So there's those 2 standards, is or should be. The time deductible, this is the waiting period to start the bodily injury. It's similar to the element period on a health insurance policy. So on the form CP 1555, it's typically 72 hours to 24 hours. And the beginning period on the CP 1556, there's no waiting period. So it depends on the form that the policy is written on. When we're talking about coinsurance, so here's some criteria that we've listed. We'll do a little math with this. So if the property has a value of $1 million with a limit of insurance at $750,000, that's what the policy is set for, and there's a coinsurance clause that is set at 90% with a 5% deductible, and then the particular insured suffers a loss with the amount of $250,000. So this is the base criteria for our example. So if we do the math, we've got $1 million with a 90% coinsurance set. So $900,000 is the amount that the insured should be carrying. Remember, it's that did over should. Step 2 is to take the $750,000, that's the did, and divide that by $900,000, the should. So this equals to 0.83. So essentially what this is telling us is the insured has a policy with a coinsurance of 83% when they're being required to have 90%. So you're going to take the amount of loss, that $250,000, multiply it by 83%. You're going to get $207.50. Then you're going to take that 5% deductible, which adds up to be $37,500, and subtract that from the $200,500. So that leaves us with $170,000. This is what the policy is going to pay out. So the remaining $80,000 of that $250,000 loss will not be covered by the insurance. The insured will have to come up with that money. It's basic coinsurance. When we're talking about the loss limit approach, so when the total value coverage is not an option, the property limit is less than the total value that's at risk, but sufficient to cover the total values actually exposed to a single loss occurrence. So commonly the limit matched the value of the largest building on the schedule. The deductible is based on the loss limit, set at either 5, 10, or 20%. And the max limit available is typically set at $10 million. $50 to $60 million maximum on total value of property schedule can be considered in our brokerage department. And factors to consider with your client is the spread of risk if they have multiple buildings, the dependency on the coverage, as well as their current budget. So you want to take all of this into account when you're talking to your insured about what limits they should have. When we're talking about earthquake and DIC, again, some description for the product. A single incident is defined at a 72-hour period. Coinsurance options, typically anywhere from 80, 90 to 100% at actual cost value or replacement costs with some carriers. DIC perils include earthquake, landslide, as well as flood. We do have the ability to schedule docks, retaining walls, and bulkheads. These deductibles are typically also set at 5, 10, and 20%. And we do offer minimum premiums at $350. The contract capacity per location, as far as earthquake, we can write as high as $11 million in-house. We can go higher with our brokerage department. We can go as high as $7,500,000 for DIC. Loss limits in excess, again, in-house authority, we have up to $11 million. And each location is defined as all buildings on a single property. So that can be more than one structure, but if it's something like an apartment complex and it's listed as one property, that would be the definition of the location. As I said, we can go higher with our brokerage department. So I think the last highest limit that we went was up to $46 million. We can go higher than that though. So some common exposures, we've got basic coverages for the EQ and DIC. We've got building, contents, and debris removal. So the building, that's going to include the completed additions, newly acquired building, fixtures, permanently installed machinery. When we're talking about contents, otherwise known as BPP, it has to be listed on the declaration or within 100 feet of the premises. This can include furniture, equipment, stock, tenant betterments, newly acquired property up to those 30 days, and then debris removal. The expense to remove debris of covered property by a covered loss. So the form typically includes 25% of the physical loss to covered property inside the limit. In our brokerage department or through endorsement, we can go on higher limits with this. We also have Ordinance of Law, the loss resulting from the enforcement of laws or ordinances. We've got coverages A, B, or C. You, the agent, can talk to your insured. Some choose all three, some choose one or the other, some choose maybe A and B, maybe B and C. It just depends on the need of the insured. And then business income. This is the loss of revenue or extra expenses that are incurred. So coverage for loss of sales or operating expenses, including rents, key employees, leasing of new equipment, maybe additional advertising or hiring new or temporary employees. We typically write with an agreed value, so it's specified on a monthly amount, either for 6 or 12-month intervals, with an agreed upon amount at the beginning of the policy period. There is a 72-hour waiting period. Extended period of restoration is available on request. Couple of additional coverages, that sprinkler leakage and loss of rents. You'll want to have a conversation with your underwriter if these are some coverages that you want to add to the policy. So why purchase business income for this particular type of policy? It protects the income of profit of the business. It can replace the lost sales and income of the business. The business is able to keep its key employees even during time of maybe extended period of shutdown. The business will always have funds to operate temporarily while the location is being rebuilt. The business will likely receive a faster loss settlement on the property claim. And business income losses can be and usually are larger than the property loss itself. It leaves the business in a much stronger position to retain the valuable customers as well. So it's really a protection. If you have any questions about this particular type of coverage, please don't hesitate to reach out to us. For those Allstate agents, you can email us or give us a call, csr@gogus.com, or you can call us 844-859-1766. For those non-Allstate or independent agents, info@gogus.com, 800-562-8095. Again, my name is Carly. I'm the marketing representative. I'm also here and happy to help if you have any questions. We want to say thank you so much for working with us. We really appreciate it. We look forward to working with you more in the future. Have a wonderful day.